What is going on, investors? Hopefully, you guys are doing well out there. Time to talk about Corsair Gaming Incorporated, ticker symbol CRSR, one of the smaller companies that we look at here on the channel. But I love this. I love these smaller cap companies. I'd love to introduce more of these in our regular series of videos. Got a $1.8 billion market cap on this one, and it was much higher. Over the last year, the stock is down over 57%. In fact, about a year ago, this one was close to a 52-week high at about $48. Now in the after hours, trading closer to $20 per share. This one's been up. It's been down in the after hours. We'll talk about some of the reasons why. The company reported their Q4 earnings. We'll talk about them. Take a look at the revenue. We'll take a look at the upcoming guidance. They gave guidance not just for fiscal year 2022, gave us full year revenue, kind of full year profits. They also gave us all the way out to 2026 on this one. So interesting that the company decided to do that. And I applaud them for really giving us a good insight into where they think the company is going over the next 3 to 4 years. Take a look at the revenues, the profits, everything that you need to know. I got a lot of comments on my video. So I posted a video 3 months ago on Corsair. I got a ton of comments, a fair amount of views. 11,000 is actually a fair amount for my channel. I got a lot of comments on here saying the products are good. Look at the reviews on Amazon. Guys, don't look at the reviews on Amazon. If every Twitch gamer was a stock expert based on them buying the product and looking at reviews, they wouldn't be a Twitch gamer. They'd be a multimillionaire. You really should be looking at the stock chart. We'll look at Corsair Gaming from a technical perspective. I'll tell you, this is doing a very predictable thing from a technical perspective. As you can see here, I'll tell you when, if you want to buy the dip on this one, you like the products, you like this company, you think it's a great opportunity over the next couple years, I'll give you very specific instructions from a technical level. And if you are patient and you wait, that will give you much greater odds on this one, because I posted this video 3 months ago. This stock was up over $25 per share. You guessed it on the video. I did not support buying this one. I didn't think it was a great idea, and it's down another $5 per share, which on a $20 stock is actually quite a significant move on this one, and you would not want to have had that happen to your portfolio. So I'll talk about it from a technical perspective as well. Let's jump into the numbers. The Q4 came in, revenues of $510 million. Unfortunately, year over year, that's down 8.2%. We'll come over here and look at it. We've got $556 million in revenue last year on a quarterly basis, all the way down to 510. Guys, nobody in this market, when this market has huge volatility, when you see stocks even like Facebook that have huge cash flows and still huge profits, even the PayPals and the Alibabas, they're getting tossed out with the bathwater. A stock that is declining their revenues on that top line, definitely going to get beat down a little bit. We saw it on a year over year basis, not paint that good of a story as well, although you are up on a year over year basis, but this last 3 months was actually pretty bad for Corsair Gaming. Now, they gave guidance for the upcoming year, so we just had fiscal year 2021 for Corsair Gaming. They gave us fiscal year 2022 guidance. They say net revenue is expected to between $1.9 billion and $2.1 billion. The street was expecting closer to 2, so they're basically smack dab in the middle of that, but that will basically signify flat year over year growth. The company just did $1.9 billion worth of revenue for this previous year, and the upcoming year, they're basically projecting right in that range. From a rounding perspective, basically flat. That's not going to get investors, quite frankly, that excited about the upcoming year. But they did give us a stretch out all the way to fiscal year 2026. So essentially, I guess 3 to 5 years down the road, they're expecting revenues to be in that $3.5 billion range. How they see out that far into the business, I'll let the management decide. I'll show you some things that definitely are hurting this company from a margin perspective. You could make an argument that some of the components and stuff like that is keeping revenue under wraps, but I'll talk about some of the risk in assuming that as well. Let's jump into these numbers. So we have this $510 million worth of net revenue. Again, last year we're sitting at 556. We're down. Nobody's going to like that. Your gross profit went down as well from 153 down to 121. So when you see this, if you happen to own this stock already, you haven't got stopped out of it or you haven't sold it, you're just, you got diamond hands, you're holding on to this one. When you see these revenues decline, and on top of that, we got the company guiding for the upcoming year basically flat as well. Okay, they're going to do about $500 million worth of revenue quarter over quarter for the next year as well. Okay, it's not going to get any better. Okay, maybe in the next year and the following year it might, but it's not going to get any better. So if that's the case, you want to make sure their operating expenses are staying in check, because if they're not, then this company is likely still wildly overvalued, because the multiple is just going to compress. When you're not growing your revenues, you're not going to get a multiple on revenue growth, because you're not growing them. And if your income from operations is declining, well, nobody's going to give you a multiple on your profits as well. In this case, we did see them keep them in check nicely. Okay, they did tick up. I would actually like to see them tick down. You went from 95 million down up to about 96.7 million. Again, some of that is in sales and marketing. Some of that is in product development. A company like this has constantly got to make products. I understand that argument. They spent a little bit more money there. Sales and marketing essentially flat, although with sales and marketing and general administrative basically flat on declining sales, that's not necessarily a good sign as well. So you get this operating income. You got the 121 in revenue, 121 in gross profit. We had 510 in revenue, 388 in cost. That gives you $121 million worth of gross profit. Then you minus off your operating expenses of about 97 million or so. And then you come down here to operating profits of $25 million. You see that's down over 50% from the previous year. You were at 58 million. You see for the full year paints a very similar story. You were at $158 million worth of operating profits and you went down. That is a problem. You went down to 137. And again, I want to remind you, the company guided for the same amount of revenue as they made in 2021. We have to factor in maybe inflation, maybe some supply chain stuff, not going to allow them to expand margins. Well, your profits are going to come probably at the very best about the same as what you did this year, and maybe a little bit worse if you have some supply chain issues, you have some inflation on that cost side, certainly employees as well. We'll see how Corsair handles that over the coming year. You're in a $1 diluted. In the quarter, you made 25 cents. Again, we're assuming this company is going to be able to do that for the upcoming year. I think here's the story about Corsair. Instead of going to Amazon and looking at customer reviews or buying these products and showing them on Twitch and how cool they are. Look, I'm not going to underestimate how nice these products are, but they're not as nice as really you've seen because they should be able to expand margins. We've seen other companies like Apple, like the strong brands in the stock market, they've been able to expand their margins. We've actually seen Nike over the last year actually expand their margins. Look at Corsair. You went from 35.9 on these gamer and creator peripherals down to 29%. Your margins are contracting. That means a couple things. Number one, it means that the cost of the components, they talked about in the press release that they gave, that GPUs are hard to find at a reasonable cost. A lot of the other peripherals, a lot of the other stuff that goes into the products are hard to find. But again, I talked about how Nike's facing that same challenge. Apple is facing that same challenge. And look, I'm not trying to compare two of the greatest companies in the world to Corsair, but I'm showing you that this company, when you invest in these micro cap companies, these macro events like inflation and supply chain affect them far more than the big guys. This is why you want to be careful about your sizing and your investment in these companies. Is when the macro environment really comes down, it really hurts. Take a look at these total gaming components and systems. Margins went down from 23% down to about 20.7. Overall, total gross margins all the way down to 23%. Last year, they were sitting at 27, so they were actually much higher last year on a quarterly basis. Again, we do not see this with Tesla. Tesla expanded their margins. Nike, Apple, a lot of the big brands actually expanded their margins. This company is not. It's telling me, number one, supply chain stuff is difficult. I understand that. But number two, their products are probably not that great. Okay, if your products were as good as Nike, look, they're not going to sell as many shoes as they do gaming systems. I understand that. But if their products were the best in the market, they'd be able to get a premium price for it. They'd be able to charge more. They can't. That's a problem. Now, moving on to the balance sheet. This is really interesting as well. This actually deserves a lot of research here. I don't necessarily like what I'm seeing here. We've got our cash and cash equivalents went from 133. Again, this is the end of last year. You'd expect after a holiday season, because this is December 31st, right? Some of their products don't necessarily be used as gifts. I understand that, but you'd expect a strong holiday season for a company like this. Some of this is bought as gifts, or maybe you get some money for Christmas and nobody gave you what you wanted from Corsair, so you went out and bought it. Well, take a look at this. Our cash went from 133 all the way down to 65. Where did it go? Because we actually see total current assets actually went up from 690 up to 705. Well, actually almost all of it went into inventory, which is really interesting. They did a lot of prepaid expenses as well. They went from 37 up to 51. So maybe credit creditors or suppliers required them to pay up front. Not necessarily a bad thing, but not necessarily a good thing either from an accounting perspective and certainly a balance sheet. But look at our inventories. You went from 226 up to 298. Okay, this is after Christmas. You'd actually expect to kind of burn through a lot of this inventory. In fact, you've got over $72 million worth of more inventory than you did the previous year. And most of it looks like to me, it came right out of the cash balance sheet. So that the margins not expanding, sales going down, the guidance being flat. Guys, you don't have to go to Amazon and see how well these products are selling. It's telling you right here, these products are really not selling that well. The fact that inventory is up, margins are down, sales are down, and we're guiding to flat year-over-year revenue, it doesn't really paint that great of a picture. Now, we'll have to look at this from a technical perspective as well. That could paint a different picture and quite frankly could make this stock a buy. And obviously, as the stock continues to go down, despite the negative fundamentals, well, the valuation could start to make a little bit more sense. And quite frankly, you got a $1.8 billion valuation on this one, $1.9 billion in sales. I don't need to tell you the multiple on this one. It is minuscule in that sense. Now, look, some other stuff going on. They do have a fair amount of long-term debt to 242. It looks like they paid some of this. So while I said some of the cash flowed into inventory, it looks like they've paid down some debt. That's actually pretty nice. Most of it didn't come to the current side. So all things being considered, they've done some nice things. Now, from a cash flow perspective, we've got our 3 months ended here. We pull down this net income number. On the 12 months, you pull down $100 million worth of net income. I don't want to make it seem like I've been eviscerating this company. If this company was completely losing money and was a penny stock, I wouldn't even waste my time. They are profitable. They have nice cost controls. I think they're doing a good job, but it's not this home run investment that I think some people are kind of touting this. And look for the 3 months here. Look at our net cash actually went negative. Last year on $43 million worth of net income, you actually had $69 million worth of positive cash flows. Now you went negative on those cash flows. And a lot of that is based on this inventory. The inventory actually flowed through negative last year, and you see for the full year actually went negative in this most recent quarter. Look, maybe they have a product coming out in Q1, Q2. Gaming might not be revolved around the fourth quarter. I get it. They might have something up their sleeve, but I think we would have saw that as well in this guidance, maybe getting bumped up for the full year. If they really had some cool product that they were stocking up inventory and maybe raw materials on, well, I think we'd see that with the guidance, but it actually came essentially in line or underneath what Wall Street was expecting. Not very impressive, to be quite frank. We talked about how this company did repay some debt, $1.2 million in the most recent quarter, over $328 over the last year. They have a credit line that they've tapped and paid back. Since they're profitable, they get a nice little credit line to buy product inventory, and they pay that back. All things being considered, not that bad. I'm a little concerned with the increase in inventory over here. I'm very concerned with the declining gross margins on this company as well, and also the fact that revenue is essentially flat year over year in terms of guidance, and we're also down quarter over quarter on a yearly basis. That's why this stock, from a technical perspective, is locked in this downward channel. You see how I have these red lines in here? You could have drawn these in a number of different ways. When a stock is in this technical pattern, you do not want to buy this, okay? The only time you want to buy this is when we peek our head back up over the technical range, okay? We got to put a green candle up over this solid line, okay? And really, technically, you got to get above the previous highs, which right now are on the stock at closer to about $22 per share. This stock needs to make a 10% move higher, and I'm talking about in the next couple of weeks, okay? It needs to get over 22, preferably probably $23 per share to show you that possibly this downward trend is over. Otherwise, we're expecting, even if this stock goes up, it will hit its head just like it's had really over the last year or so. It will hit its head on this upper end of the channel and then come down close to the bottom end of the channel. You do not want to buy it down here at the bottom of the channel. You might say, well, I'm going to pick it when it's at the bottom of the channel. Well, you could have said that back in August. You could have said that in September. You could have said that in October and December, and you would be down. You were only buying this. I repeat, you are only buying this when we put at least two candles 2 solid green candles up over and above this upper downward trend line. Okay, you got to get over and above that, and don't worry about picking this at the bottom. You don't want to do that, because you could have said, I got the bottom here, 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 and you'd be down 30 or 40% in this stock. Don't try to be a hero. Don't try to pick the bottoms on this one. Wait until we put 2 green candles up and above this lower trend line, this upper trend line that's trending down. You got to get above the previous lows, which right now are at 22. If this stock continues to go down, let's say it goes down to 14.15, then you need to get above this $20 level. You need to get above it. That will show you that potentially there's a sign of a reversal there. If you buy it at that spot, put a stop loss shortly underneath that, because it could just be a temporary fake out, just like we had back here in June. The stock rocketed up and then came all the way back down basically in a day or two. So you don't want to get stuck buying the stock up at these levels and then not getting stopped out of it. You're looking for 2 candles up above here. You get above there. There's plenty of green space. Okay. Will you get all the profits? No, but you will cut out so much downside risk if you wait for this to reverse from a technical perspective. But all that being considered, right now, this stock looks like it wants to go lower. There's absolutely no reason for this stock to reverse anytime soon outside of a buyout. You've got a $1.8 billion market cap on this one. You got $1.9 billion in projected sales in the upcoming year. They are profitable. They do have positive cash flows from a yearly basis. They have a fair amount of debt, so you'd have to factor that into the valuation as well. I could see this one getting bought out, but that caps your upside a little bit, right? Somebody like, I don't know, Take-Two Interactive, or somebody wants to come in here and buy it. I don't know who would. I'm not saying that they would, but maybe they come in here and bid this up to $30. Sure, that'd be a fantastic gain on this one from a premium perspective, but it caps your upside. When I buy these micro cap companies, I want them to go from 1.8 billion up to $30 billion company. Okay. And that's where your upside is. If you're getting bought out in these ones, it's basically capping your upside, just like we see with a Peloton and some of these other stocks that have bids out, basically bids outstanding for them. Well, your upside is getting capped by how much an Apple or a competitor is willing to pay for that. So I wouldn't really buy it based on that. I wouldn't buy Corsair because you think it's going to get bought out, but that could be the most positive catalyst over the next 12 months is somebody actually comes in here and buys this one out and essentially bails you out of this downward trend that this stock has been in. I'm sorry, I tried to warn you. I did post a video on this one 3 months ago saying I would not buy it, and I would not buy it today until we break this technical trend, and this guidance for the upcoming year doesn't appear to anything for the stock in the shorter term. That was Corsair Gaming. Good luck with your investments.